It's an exciting report today. We're covering the well-anticipated and heavily requested Sell in May mantra, as well as the cycles. Gary Glover has drilled down into the cycles he looks at to renew his confidence of being heavily invested for the remainder of 2023. These cycles are important for markets, investing and trading. They cover seasonality, presidential cycles, as well as decennial cycles. It's a lot to cover, but Gary Glover's done the homework. I'm Christopher Hall. This is Final Market Points, and we say, good morning, Gary. How are you?
Yeah, good morning, Chris. This might be most important research report I've written this year.
That's quite a heading, isn't it? The most important research you've written this year. So why is it that you think it could be the most important one?
Yeah, look, it's I look at I do look at my cycles there. I mean, some people don't believe in these sort of cycles. People think the market's quite random stuff, but there is a strong sort of secular base there. I think one of the reasons why we've had a pretty strong success in the last few years, and particularly when everyone else was long in NOV 21 and we were getting short and getting starting to build up a short NASDAQ position there. It's kind of around a lot of these sort of bearish cycles and just looking at putting all the pieces together. But look, we've sort of had our outlook. So I've always been pretty bullish about the prospects of the midterm year. So October midterm years are synonymous with deep lows, big anchored lows there. Like a lot of deep lows come in those sort of 4 year, and it's almost like an anchor in the market, pulls the market down. We get some really great recoveries out of that period there. So been pretty bullish about that. Usually sort of October is our deep low, March being our first sort of higher low, and then markets sort of climb into May, probably get a bit messy. So I was just kind of thinking, I just sort of revisited the cycles there, sort of update myself, because we're sort of, so far, all the cycles have followed, the game plan, so almost to a T here. The 60-year cycle, which is the other cycle I follow quite closely as well, been very prominent. Market's been following that, quite closely as well. So all those cycles have really been in nice unison for the last few years here, and that's been the reason why I've sort of been had a pretty good grasp of the market there. So I think we've sort of been on the right side here for the last few years, and that's the reason why I'm sort of still concerned about commodities here, Chris, as well. So last week we saw BHP and Rio, quite a few of the big resources actually hit new lows for the year. So I know it's been pretty choppy there, but that's the sort of basis for that view as well. The cycles have sort of been pointing to those sort of coming lower. So just think it's really interesting here that we're after sort of revisiting the cycle work over the weekend, it really sort of shone a bit more of a positive light, and probably a bit more positive than I was anticipating. If I'm quite honest, I sort of thought it was going to be a bit of a messy end to the year, but now after having a look at these cycles there's some really compelling data there, and then again, it's looking at the cycles, piecing it all together, looking at the landscape, and then does it sort of fit your thesis, and then going from there. So after the weekend, I was a lot more positive about markets after doing this sort of homework here. So let's sort of maybe start at the NASDAQ there, and
get on into the report.
Way into the work into the sell in May and maybe not go away.
Well, I'm really looking forward to all those charts and the cycles, because as any viewers who have followed you for the last couple of years, more years than that, but specifically the last couple of years in the COVID period, these cycles have really helped you pinpoint the highs, the lows, the turning points, and loading up and de-risking the portfolio. So that'll be really good to detail. But if we just start on this NASDAQ, I'm excited to see cup and handle in such a large and prominent indices in the world. This cup and handle, is that something that you're keen to see with this tight compression under the high?
Yeah, so I mean that's synonymous with sort of growth and kind of momentum stocks, so the strongest sort of stocks here. So we've sort of got still got a pretty bullish sort of setup here. So all congesting under the high here, haven't sort of pierced or broken above it here, but if we close above this level, Chris, that'll be quite a bullish sign there. We'll definitely have a lot of the bears in disarray. And there's plenty of those. There's plenty of bears out there. So there's Lots of people who, I think, consensus view is pretty light on here. Recession definitely coming. This is a bear market rally is probably what the, where the majority of the market sort of sits there at the moment. So we've really seen growth stocks start to outperform here and moving high. Interesting sort of fact I did see during the week there, which I thought was really interesting, was that the people talking about the number of stocks still under the 200-day moving average, so it's still pretty high on the NASDAQ there. So still lots of stocks that are still haven't broken above the 200. So that's a little bit of a negative there. But if we look at the NASDAQ 100, which is obviously the leaders, significant number of more have broken above the 200, like maybe even twice as many. So the percentage is sitting a lot higher for the leaders there. So the leaders are leading here, Chris, which is interesting. And that's a sort of a bit of a building sign too. So I know everyone's looking for more depth, and that's when you're in a bullish market, you want to see depth. That is a good sign. But when you're building in the early stages of a base, it takes time to sort of get to that point. So we shouldn't sort of throw the baby out with the bathwater because we haven't got there. But interesting that the NASDAQ 100 is significantly more stronger than the broad index. So the leaders are starting to sort of lead here. But the short and curly of it here is that we do have a nice cup and handle here. The handle's pretty tight. Hasn't weakened off much, which is a good sign. And if we close above here, that's going to be positive. And that will have that will have the bears on the ropes. Like that'll be throwing them for loops for sure.
Well, that's really positive to see that and hear that. The leaders are leading in the NASDAQ, definitely the top 100. Clearly, from a market capitalization perspective, that's helping create this formation and tight compression. If we move over into the S&P 500, has this also been base building, or how do you view what's been happening here?
Yeah, similar pattern. I mean, this is just the ideal. This is the ideal buy setup. If you look at Stan Weinstein's sort of stage analysis there, really. So this is sort of like we're in sort of breaking up into sort of stage 2 here to come back and retest the break zone. It's very common as well set up. So again, probably like to see a bit more volume, a bit more depth there. But again, not seeing the volume on the down days. I think I've seen there was 2 or 3 distribution days there, in the last month there, but that's it. And then we've seen a few more strong days as well and some strong volume as well. So after that little bit of a pullback there last week, the market rebounded back pretty strongly there. So that's a good sign there. So again, we're sort of, we're curling up here under the high again. And yeah, so you do like to sort of see a market go there quickly, but this is kind of building here. So that maybe it'll consolidate a bit longer here. We might even get a couple down days here before it, but yeah, I still think it's pretty constructive here. So can't see anything too negative here at this stage. Yeah, still looks positive to me.
Well, one that was positive for a while, we had 7 weeks down on the Aussie. Then we had a quick reversal, 3 weeks up. Now we've had 2 pretty lackluster weeks on ranges. And the volume, well, you've got a little highlight here. So what's your take on the Aussie?
Yeah, so I thought there was a little bit of a distribution week last week after a bit of a rally. And that's probably rallied back, sort of 2/3 of that range. So it's a pretty good bounce there. And there was a little bit of distribution there last week. So that's probably a little bit of a negative for me. So I thought, okay. And I'm sort of worried about those commodities sort of resource stocks, the big ones. So thought they might sort of drag us down here. But I was pretty impressed with the way the market held up here. And really, we did have a down week, but no volume there. So considering that BHP and Rio did, fall away to make new lows, index has held up pretty well. So that's good signs that maybe, the rest of the sectors can sort of do some of the lifting here and sort of maybe hold the index up. Could get a few more weeks, might get another week or 2 of consolidation here. But I do like the fact that we, for what was a sort of bearish week last week, and this was, if there was some follow through there and some pretty heavy selling, then I'd be pretty negative there. But there wasn't follow through and the selling was very light. So that's constructive in my opinion. So yeah.
Well, if we move to the Dow Jones, sort of another older world, more value, less growth, but still a lot of growth companies in the large end of the US markets nowadays. What's your
Yeah.
interpretation on the Dow Jones chart?
Well, it's funny that the Dow Jones did actually originally lead this rally out of the October lows. This was basically the most prominent, that was the index which led out of the October low. So, recently the NASDAQ has been outperforming here, but if we look at the technical picture here, we've literally just broken out of that sort of consolidation range there. So kind of a little bit of a pennant flag here, but just breaking out of that pattern there. So I've had a little, three-way pullback, started to move up there. The breadth is starting to improve. Not seeing any, too many distribution days. And I love the way that last week sort of, we saw a little bit of weakness there, but then we sort of rebounded pretty strong. We have sort of finished outside of that break there. So technically, that's kind of a pretty bullish sign, actually. So interesting here that this might be leading here like it did out of the October low. But interesting fact here, Chris, as we've spoken about quite a few times in the past here, the average rally out of that sort of midterm year low is around, for the next sort of 14, 15 months, is around, I think it used to be around 48, 49. I think in recent years, it's sort of around 47%. But it's on average, we get big moves out of these late year, which is usually around October in those midterm years. And just a pretty bullish setup here. So, if we just go back and retest the high here, Chris, that's a 29% gain from the low, which is well under the average. I think around 47%, which is now the sort of the new average. That would be around about 42,500. So quite a bit higher. No one is going to see that. No one's calling for that. Look, maybe we won't get there. Maybe we just go and retest the high or something there. But just saying, just looking at the averages there, where the averages is considerably higher here. Just pretty interesting here. Technically, it's good signs here. I know we've sort of got interest rates moving higher. Pending recession here, obviously, a few concerns there out of the States. So, probably shouldn't be, too optimistic about, getting to that average. But as we have sort of shown in the past there, if you look back at those high inflation periods historically, inflation does not need to go away. It just needs to be. Yeah, it just needs to sort of reduce. So basically, we've seen in the past, in the 70s and the 40s there, when inflation did cool off, the markets did go for some fairly, what do we call it, face-ripping sort of rallies. There's some really sort of, sharp rallies in there. So if you remember the sort of 70s and 40s, we had big moves up, big declines, big moves up, so end up with a big, big range-bound period. But we did see some big rallies on the back of inflation just cooling there. So, there's some probably headwinds ahead here, maybe for the next, few years here. But just if that inflation number does keep cooling off here, that's probably going to propel this rally here. If you look at, how that inflation figure, has what it's meant in the past out of markets there. Market will get excited if inflation continues to sort of cool here. So, it looks pretty positive. I mean, technically, it's a pretty bullish breakout there. So, unless we sort of make a false break here and come back in, I think this looks pretty positive.
Nice. Well, we'll watch that one transpire. But that will be happening throughout the month of March. And this week's report has strongly requested, you're addressing this sell in May mantra. So from what I know, the name is sell in May and go away, and quite possibly it's continued up with and remember to buy in November. But if we just look at the May component, is that what you've got here on screen?
Yeah, so look, it was a great, actually, quite glad actually one of our viewers sent us a note requesting it, actually, because it sort of forced me to go back and revisit a few things and do some further analysis. And sometimes you write your research at the start of the year, and then 6 months later, it's not top of mind. So sort of going back and having a really closer look at it in detail, and kind of where we're sitting in the cycle as well is pretty interesting. But there are some definite seasonal biases, particularly in the Aussie market, and you can point to historically there are a lot of sort of late April, early May peaks on the Aussie market, and we do sort of get typically a bit of a corrective phase in there. Most interesting here is in recent years, if you look at the S&P 500, we haven't seen too much weakness actually in May, and the S&P 500 there was only actually down 1 year out of the last 10. That was 19, which was obviously down quite hard, but all the other months were up. So only 1 out of 10 was actually down in recent times there. So that's not exactly sort of giving us the roaring sell order or the sell in May confirmation that we'd like to see. So I thought I'd go look a little deeper into the presidential cycle, because that's the other sort of one that's really prominent here. And again, we talked about this midterm year. This October midterm years are just synonymous with lows. I mean, if you don't believe me, just go and get a cycle line and match up every 4 years, every midterm year in October, and just put a line there and get a 4-year cycle and look at 100 years of data. You'll be horrified how many deep lows. Market just bounces out. It's like an anchor pulling the market down into that period, and then like a band letting the market go out of that period. So it's just amazing. There you can see the second chart there, really that midterm year low up into the end of the pre-election year. That's the best. That's the strongest period to be long. The best sort of 3-month period. I think it's the best 12 and 15-month period of the 4-year cycle to be long equities. So just, I know it doesn't always match up. Sometimes it's not going to work here, but historically looking at, that's the 100 and I think it's like 115 years of data there. That's our average there. If you look at the last 59 years, it's even more prominent. It's actually been probably stronger in more recent times, and actually finishes stronger towards the end of the year. So in the recent sort of years, it's actually really run through to December there. So that is pretty prominent there. And with looking at the pre-election year, we get a little bit of a pullback into May. So we do often sort of can pull back, have a little shake back into sort of mid-May. We often get a little pullback into August, and we can get a pullback into October there. So those are the 3 months there on the pre-election years to sort of look for maybe lows here. So yeah, but generally this is the best 15 months to be long from October midterm year, which happens to be October 22. And yeah, I mean, so far it's been bang on. So if anything, we're actually probably underperforming the average. So, but yeah, maybe we don't have the strongest conditions, but yeah, still pretty positive.
Okay, well, if we move to have a look at the next chart that you have, so you've raised the 10, 20, 30, 40, and 60 cycles. Before you jump into the chart, can you just quickly explain what these cycles are?
Yeah, so apart from our sort of seasonal cycles and then our presidential cycles, they're sort of our next really important cycles are really our what they call the decade cycles. So basically all our 10-year cycle, basically our second and third and seventh year, they're all sort of they can be quite similar cycles there. So I think it's something along the lines of Chris there. I think it might be like 8 of the largest. I think 8 of the 13th largest corrections come in the last quarter of the 7th year. So there's definitely statistical biases towards sort of certain years, and then the 5th year is often been labelled the year of extension, and I think there might have only been one negative 5th year in the history of the markets, and I think the 5th year outperforms every other year by about double. So there's definitely some biases there and some cycles there, but the most important cycle is to look at the 60-year cycle. That's the sort of it's like that sort of almost generational sort of market forgets what happens in the past and it just repeats again. And then the 10 and 20 are really important. If the 60 is working, then we really should be looking at the 30, which is sort of half of the 60. And then we're just looking at all the other 10-year cycles, the 50, 60, 7-year cycle as well. So those are the sort of next important cycles. But really, the 60 and the 10 and 20 are probably the key ones to sort of really look at there. Those are sort of ones that tend to sort of map. And then when they're all sort of consistent, that's when you often get your best years in the market here. So it's just interesting looking at the 60-year cycle, which really has been bang on. That's been sort of my sort of, the strong roadmap, and then the 20-year as well. Those have probably been the two. If I just followed those two, combination of those two for the last 3 or 4 years, I would have had like an 80-90% success rate. That's been pretty bang on. So it doesn't always work there. There's usually sort of 1 or 2 years they go out of sync. If they go out of sync for a year, they usually go out of sync for the following year, and then they fall back into line for a few years. But they went out of sync maybe 3 or 4 years ago, and then they've been in sync ever since. So, but the 60-year cycle is pretty interesting here. If you look at the 63, from that sort of just looking from May into the end of the year, the smallest drawdown was like 4.21%, and I think the market finished 6.88% higher for the year. So, okay, so it's interesting there. Pretty small drawdown in 63. If I looked at 83, which is the 40-year cycle, this had the biggest drawdown, 5%, and I did finish about 3.39% higher by the end of the year. But stayed pretty tight. 30-year cycle, literally had a 2% drawdown after May, and end up sort of finishing about 5.65% higher. Again, pretty choppy, but just sort of climbed higher. 2003, the drawdown was like less than 2% and finished up 19%. So finished up pretty strong here, the 20-year cycle. So that's pretty interesting. And the 10-year cycle, again, pretty small drawdown, 3.5% here, and finished up 14% for the year. So pretty solid gains there. So looking through that sort of sell in May, so looking at a 10-year cycle, looking at our pre-election year cycles there, they're generally all saying the same thing, Chris. They're basically saying this market will slowly creep higher, and any drawdowns will be small. So it's quite amazing when you look at all those third years of the decade, just how small those drawdowns were. So all less than 5% here. And this is usually after coming out of some pretty deep lows in these sort of second years. So think about 82, 2002, and obviously just 2022. They're all sort of coming out of deep lows. So pretty, and that 4-year cycle as well. If you look at the midterm year lows, they're all deep lows as well. So, just statistically, we're often sort of coming out of these low periods here. So history shows some of the smallest drawdowns occur in the third years of the decade and after these midterm year. And why is that? That's what I thought, because when I looked at that data, I thought, wow, that's pretty fascinating. The fact that the drawdowns were so small. And it's probably because we're generally following some pretty deep sell-offs. So again, those pretty deep sell-offs into those years. You think about people are generally, slow to get involved, and eventually, they initially are underinvested in the early stages of these sort of bigger sell downs. As a result of this, everyone sort of ends up sort of playing a bit of catch up, and you're almost sort of forced to be sort of buying any dips. And so that's the psychology of why the drawdowns are so small after this period. I thought it was fascinating. So, where are we right now in the current investment landscape? Does this support maybe this thesis, okay, in terms of the cycle? So for starters, the majority of the market still remains quite bearish. Lots of analysts are still playing the short side, and everyone is pretty much positioned or believing that we've got an impending recession's coming. So most money managers are way underinvested, sitting in lots of cash. It's been widely reported over the last month just how underinvested most money managers are, and that's pretty consistent with a lot of the great lows and the big troughs in the past. So human nature to get scared at lows after aggressive selling takes place. There's reluctance to get involved in the market bounces. People slowly wade in only after they get either one, more confident with the market climbing, or two, they're playing catch up. They're basically forced to come back in the market because they got, FOMO. They're basically, if they're missing out, everyone's starting to outperform them, and they're almost forced to participate in these rallies. So, the thing about markets is markets climb the wall of worry. They always have, and they always will, over and over again. So they're generally sort of climbing this sort of wall of negativity, and there's usually, so I think it was just fascinating here. I think we really are in that typical landscape of, and that does support the thesis that maybe we're just going to slowly grind higher here, and we're not going to see big declines in the market there. And my thesis is sort of saying, but by the end of 2023, we might be back using the phrase "buy the dip," because the dips, historically in those sort of cycles are pretty low here. So, I was actually, after sort of looking at the data there and the landscape there, it matches up succinctly. So, and everyone is so underinvested. I just think they're just going to be forced to participate here, and so it's not going to be maybe a rip-roaring rally here, but I think it just basically tells us here that any pullbacks, say 2.5 to 4.5%, should be bought. That's basically what the data is telling us here. Any pullbacks in the market should be bought. So the drawdowns are small. So that's what sort of I got out of the weekend. I thought it was pretty compelling. I thought there's good psychology around it. Some really fundamental reasons as to why this. I know there's a recession coming, earnings going to be impacted, but the thing about those recessions there, Chris, is it's a bit like the interest rate cycle as well. They've been so well scripted here. So you're talking about interest rates rising in Australia here. We've been warning people for 12 months here now that interest rates are going to go up, and this sort of fixed market onto variables going to hit everyone there. But that's been like a year. Everyone's been talking about it. So look, I'm sure there's going to be some people who, it's like everyone, who'll get into trouble here. But majority have had so much time here to prepare for it. History says that if you give people a lot of time to prepare for it, they generally will. It's usually sort of, if there's something out of left field no one's prepared for, that's what hits people for six. And we've been talking about a recession in the States here for probably 18 months, maybe 2 years now. And, technically we might have had two negative GDP periods. Obviously the employment figure didn't quite match, so we didn't technically get the third one, but it does cause, when you sort of got negative fundamentals and noise out there, it'll force, we're already seeing the companies are already trimming. They're trimming the fat, they're getting leaner and meaner. Still plenty of jobs out there. So the people that come out of these unprofitable companies, there's other companies out there still looking for employees there. So the labour market's still pretty tight here. So just a bit of a slightly different skew here. I mean, to maybe other periods in the past. Obviously, hard to sort of map pandemics there because we only get them once every 100 years. So just a little slightly different. But I don't know, I'm sort of optimistic here. I think I definitely left the weekend thinking, wow, this is a little bit more positive than I thought here. And there's a good basis as to why the market might just sort of churn higher here until the end of the year.
Well, that's really great in-depth analysis on all those different decennial cycles, and amazing that they clock up with very limited drawdowns from the month of May, which you've highlighted in those red boxes. Overlaying that with the presidential cycle, seasonality of markets, that's really quite compelling. So compelling to be fairly invested for the rest of the year. But if we are fairly invested, that sort of brings us back to the normal part of your report, which is, well, we've got to find some trading shares in there. So we may move to those trading shares and pick up Life 360, which you've got emerging slowly on your report here. So what's the focus in this chart for you?
Yeah, so sort of like those sort of market periods there. There's sort of, I think there's only really one period there where the market really got aggressive, but most of them were just sort of slowly climbing from May. So, and the market's like that too at the moment here. We're just not really, market's not sort of getting lots of breakouts and stuff there, but then they might run for a few days and then they cool off and then they build again. So this market is definitely not in a hurry, but it is emerging slowly. We're definitely getting a few more winners there, sort of starting to move out and move up big. But yeah, I just thought 360 looks pretty interesting here. Sort of has broken that descending triangle there, had a little bit of a pop out there, but didn't sort of get going. Had a bit of a pullback, didn't get going as well, and then we sort of had a nice little reversal there last week as well. So just starting to build here, starting to emerge. Volume a little bit missing, but the thing about 360 was I did look back at some of the lows here, and it does have some history of sort of starting slowly and starting with sort of like a kind of lower volume emerging there. So so I think still think this looks sort of constructive, and we're definitely seeing some growth there heading in the right direction.
Another one is MegaPort MP1. This is a slippery slope. We've got 22 highs back when the market was getting its lows in October. We came there November, December, 22s, coming down, falling towards sort of that mid-high fours, going for a bit of a rally to get to 10, but then drifting and waning all the way down to these recent lows, and then flick. So big rally. What's now?
Yeah. So it had a nice rally off that low there, and then it sort of had some pretty bad, sort of fundamental news come out there. So a bit like sort of Appen there, really sort of the news wasn't so good, and the stock's been pretty much in a downtrend again since that sort of July, August peak there. But just interesting here, we've sort of gone to a new low here, elevated volume sort of down here over the last sort of month or two. And then we've just had a fundamental sort of shift there last week, Chris, as well. So we saw some, pretty good update from the company. Basically, there's a bit of a pivot, a few changes, potential changes there, and just a change of fortunes in their sort of revenue earnings and stuff there. So potentially might be heading in the right direction again. Probably too early to call here, but the change in sentiment there, change in view there will be will have the market a bit more optimistic there. Just it's a nice technical sign there, going back to retest the low, bit of a false break, and then getting some strong volume out of that low there. So that has been a good sort of signal in the past there that so I think this will sort of climb here. It'll need to sort of keep producing sort of positive news to sort of go high here, but this is a good first step here. Definitely changing character for me, and definitely sort of one that could build upon this this false break here.
Well, another growth company you've put into this week's report is Kogan KGN, it's the ticker. If we just summarise this chart, we'll look at the weekly chart on screen, looking at highs back in October 2020, so into the COVID lockdowns like Temple & Webster, a lot of online sales. Coming up towards 26, it's been one-way traffic almost to sort of July.
Yeah, nasty bear trend. Yeah. And then it's funny that the actual low was in July there, Chris, not actual.
Not with the market in October.
Yeah. So the stock was actually making a higher low in October when the market found a low. So that's always a good sign. But yeah, look, it's not going to go back to the old highs, but it is sort of starting to build a series of higher lows in there, and definitely the selling has definitely sort of dried up here. There'll be a lot of losers on the way down here. There's still so there'll be probably a little bit of headwind to stop it sort of going up here, and that's why we're sort of it's taken a while to build a base here. But what is constructive there is we've sort of got 3 or 4 higher lows in place here now. And it just sort of keeps building there. And we're just starting to see a little bit of volume come into the rallies as well. And, look, not going to go back to the same highs there, but definitely, we see a sort of move here out of these sort of $3 or $4 level up to, $5 or $6 there. Still pretty good potential moves out of that stock there. But just starting to see some positive signs emerge there, which is, just sort of good overall for the market and for growth stocks there. That's probably been one of the ones that's been punished pretty hard, as has MegaPort as well. So those stocks have been, they're just sort of starting to build here off these lows. So I just think that's a good sign there that some of the stocks that have been probably heavier hit have, are sort of starting to build here. So I think that's sort of constructive.
Well, these ones have been on a downward slope for some time. We move into Bank of Queensland that's on a pretty steep slope right now. For the listeners who haven't been trading with you and are not trading clients, you're quite well known for trading the banks through their bandwidths of PEs and the high range, the low range, and doing very well with that for longer term portfolios. So with that kind of context of your success with trading banks for quite some time now, what's caught your eye in this rapid down movement for Bank of Queensland?
Yeah, actually, you've spelled it out 100% correct there, Chris. And I didn't even prompt you on any of that. So, but it is. I mean, the banks. I mean, historically, the banks sort of, usually trade in sort of trading bands, and that's sort of, usually sort of trade in PE bands, and those bands have changed over time as well as the earnings have changed. But we're literally. Bank of Queensland there is sort of, its latest update there was not so great. Did sort of show some deterioration in the margins there. Definitely showed, obviously, apart from the big banks, maybe the market sort of, shortening up a little bit. You've still got all these other small players as well. Obviously, Macquarie AMP are sort of doing a bit of banking, got all these, Judo and all these other sort of smaller groups there. So very competitive space there. But yeah, so the margins, have deteriorated there, but with price sort of coming back to more sort of normal PEs and the yield there close to 8% there. So even if you sort of shave off earnings a little bit because of those margins there, you're still sort of looking around sort of 7-8% here. So I've actually been using a few options there just to use the volatility there to sell a premium there and get a lower break even, get a juicy premium there. So my break just basically means I get a softer break even. So it's a bit of a strategy for options players. And yeah, effectively basically means that if the clients land the stock there, they're going to be landing it with an 8% yield, which probably happy to hold that in the short term here on those yields there. So definitely a bit of a bottom picker here, which is probably not my style here recently, but for value clients sort of longer term holds, I think it's pretty interesting here, sort of under 580. I think sort of around 570 it would be pretty compelling for me. So it looks again don't really like buying lows there, tend to get burnt here, but I just think the banks are a little bit different. They're different beasts there. There's usually sort of parameters around the earnings and PEs and stuff and the yields which tend to sort of find support there. So slightly different. I wouldn't use that same sort of methodology for resource stock but yeah, definitely some value emerging in Bank of Queensland there. And it's, market's got to bully something here because, you've had the regional banks in the US all sort of sell off here. So if you're sort of trying to play the same strategy here in Australia, you'd probably be long. The hedge funds might be so long the majors and then they'll be short some of the miners there because obviously the cost of funding is more expensive for the regionals. And it's just it's probably just a bit nice pairs trade. At some stage they're going to unwind that trade. But it makes kind of sense as to why it's sort of come off here. But I think it's just a bit of a value trap there. And then if you have the thesis that market's going to buy the dips here and chase anything that's sort of with a pretty nice yield on it, which I do think they will, I think they'll look to sort of come back in here. So I think it looks sort of pretty interesting.
Well, that's a very good breakdown of the banks, the ranges that you've talked about, the yield as well. We haven't talked about yield for some time. And good to note that this is more of a value play than your normal momentum and growth trading strategies that you've been working with. So at that point, we'll probably say thank you very much, Gary Glover from Novus Capital.
Thanks, Chris.
Now, Gary's report, as you can see, we go through it in quite a lot of detail. You can subscribe down below, click subscribe there. We also get the Friday reports, which we'll put on the right-hand side. This is where Gary goes through the 30-30 list with top momentum companies and then those poised to break out on the launch pad. Also on the right-hand side, the strategies that Gary's talked about, volatility, contraction patterns, springs, false breaks, those kind of things. Also the 40s and 70s inflation. He goes down more detailed research. They're also on the right-hand side. And to get in contact or to follow Gary, there's his Twitter handle on the left-hand side.